All right, good morning, Rhinos. All right, what a wonderful day. Let's see what's going on. Let's get all together. Let's get set up. And let's let everyone get in, right? Come on in, come on in, come on in, come on in, come on in. Just filled up my water, which again is a Voss bottle, but it's tap water. Actually, you know what? It's filtered water. I went actually all the ways over to the kitchen today. I went on the other side of the office to see how the other people live. And I gotta tell you, so in my office complex, there are people that know me, and then there's like people that heard of me, right? Because I never leave my office, nor do I ever talk to anybody. So if you're in my vicinity, you know Anthony is like, hi, how you doing? Okay, cool. And I'm always in my office. For the most part, they actually have the lights off. So if you could imagine, I'm sitting here, lights off, door open, just like this, with a little bit of cello music playing, or some kind of classical music like Beethoven or Mozart. So think about what a psychopath I look like, right? You work in my office complex, you pass my office, it's a black room, no lights, no nothing, everything's shut, and just classical music playing with me saying, yeah, hi. So, as crazy as that sounds, so I had 2 minutes before this started. I actually got caught up with my work. I had 2 free minutes. And so our largest investor called me yesterday. In fact, it was him that called when our phone went out. And my wife's like, I hope he wasn't watching the live. I was like, no, he was doing something else. Because I was like cursing, like, who the calls me, right? So he calls me, and I call him back finally, and it becomes a little bit of phone tag, and he texts me and he goes, all right, I'm just going into the bridge. I'll call you in 3 minutes. I wrote back, yes, perfect. I finally get to go to the bed. He gets on the phone with me. He goes, seriously? I go, yeah, you don't understand how structured the day is, that going to the bathroom was like a real treat. I got to go to the bathroom maybe 2 hours earlier than I normally would have. That's what Rhino's like when you're in Rhino. So to get back to the story before we get to the market and wherever it is today, I had 2 minutes. I finally got caught up and I went over to the kitchen because there's a big kitchen in this big office complex. And I kind of slide in, like I don't want to say hi to anyone. I fill up the bottle with filtered water because it's like a real kitchen. It has real things. On the countertop, there was granola bars, there was fruit bars. And I was like, wow, people live pretty good here. I live in my office and think about maybe getting home at like 9 o'clock so I can maybe have some pasta. These people have like real office stuff, like real adults. And it's just a different world when you live in Rhino. It just is. So that's my little soliloquy for the first 3 minutes while everyone got in. Deborah, greetings from Celebration, Florida. And by the way, this is directly to Deborah. Deborah contributed to Rhino Charity twice, not once, but twice. And she's amazing for it. So Deborah, thank you. All right, anyway, let's get into it. So before we take a look at what the market's doing today, which by the way, I know the futures were down, right? Last I looked, the Dow futures were down, I think like 250. The NASDAQ futures were down 2%, so like over 200 points. And I remember Apple pre-market was like 158.5-ish, down 2%. Okay, so that's all I know. I don't know anything past that because I choose not to know because I like having these calls with us as a real boot camp, right? So if you and I were speaking to each other last night, if you were one of the high net worth clients that I did have years ago, if you were someone that was just friends with, whatever the case may be, if you and I were speaking, what would that conversation look like? And it's funny because I was watching Mad Money yesterday. It's a 6 o'clock show on CNBC with Jim Cramer. And I was watching with my wife. And he went ahead and yes, today, that's what liquidation looks like. That's what capitulation looks like and blah, 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 blah. And I remember saying to my wife, I go, it must be nice to be able to tell the story of the market from a perspective of like, duh, I know everything. How could you fools not see it after the market's closed? Because anybody, which is why we created Rhino to begin with, Rhino Wealth and Rhino Premier, that anyone could go ahead and act like a savant when it comes to financial advice if they already know what happens. right? So for instance, yesterday, let's put it into perspective of what we did, right? So we were live with everyone at 10 o'clock, like we are right now. The market, I believe, was down 400. By the time we were done being live, it was down 600. And if you go back to what our call was yesterday, the main point was, all right, we don't need to do anything right now. Like we purchased a little bit more stuff, but if you were one that says, all right, this is just scary, like I don't want to participate in this. First of all, no one ever has to do anything. This is an educational platform. What you do with the education is your own. But if you feel compelled, okay, I'm on this platform, I need to do something, you're doing the wrong thing. You are not obligated to do anything. That being said, if you feel like, oh, this market's going down and I'm on this platform, I should be doing something. The advice was, or at least the research that I was sharing with you from my experiences of what yesterday's true value was as education. Just sit there, don't do anything, just watch the market, sit there and watch what was happening. Because it's been our contention and what we've been sharing with you is that this is simply just liquidation. Because when you're investing money, there are the macro idea, there's the macro bullet points and then the micro, right? For instance, you would not purchase anything in a town if the population was 10. It does not matter if that company has a cure for cancer, because the belief is of 10 people, how many people are actually going to have cancer? Therefore, even if all 10 did, you would go ahead and cure them all and then what? You would have no growth. Therefore, you need to know the macro. You need to know the big stuff, and then you can find out what correlates and best represents and best leverages that big idea, right? So say, for instance, you knew COVID was happening. Someone came to you and said, listen, COVID's going to happen. There's this big pandemic. The whole world is going to have to take these vaccines. It would behoove you to say, wow, okay, well, I'll buy Pfizer, right? And that's actually what everyone in Pfizer did, because somehow they knew this was coming before it ever was coming. But I guess they just got lucky, right? But you would behoove you to do that. Okay, we're going to double our sales from 40 billion to 80 billion because we're following the science, right? Anyway, the point of the story is you want to know the macro thing. The macro thing was COVID. The micro thing was pharmaceuticals or DocuSign, like something that you have to do on the internet because you're stuck home, or credit cards, right? Because you paid down all your debt because you have all this money and now you're free to go ahead and spend it. Like those are micro ideas from the big macro bullet point. So what you need, so before you ever can invest in the market, you need to know the macro. Because if you don't know the macro, you know nothing. And like my wife would always say, you know nothing, Jon Snow, because she's obsessed with Game of Thrones. What's the macro? So I have $1 trillion. I want to invest $1 trillion. Where do I want to put it? Do I want to give it to government or do I want to give it to the private sector, right? Do I want to go ahead and put a large, now again, you don't ever put everything all in one thing, right? Well, not when you have $1 trillion. If you have 10,000, 20,000, fine. But if you have $1 trillion, you're not going to put it all in one thing. You do allocations. So when you're sitting there, you say, okay, I have this $1 trillion over the next 10 years, right? Because you look out, when you have $1 trillion, you don't buy something today and sell it tomorrow. You have a duration. You're looking out 5, 10, 20, 30 years. All right, I have $1 trillion over the next 10 years. What do I want to buy? Do I want to put that money in government or do I want to put that money in the private sector? There's only two places to put it. Government, public or private, public or private. And the math you would do is, okay, if I put in the public sector, let me take a look at how I can do that. All right, I could buy government bonds. I could buy treasuries. I could buy T-bills. Those are all safe. They're guaranteed. The government's going to pay them back to me. Cool. All right, well, what's the rate of return? Okay, it's 1%. Well, it's not very high, but it's guaranteed. Like, I know I'm going to get 1% back. That's a good thing. If you could guarantee it, I'll go ahead and lower my rate of return because it's guaranteed. Okay, cool. But wait a second. That 1% you're paying me back, what's the inflation rate on that? Because if the money's going to erode higher than 1%, then that means not only are you guaranteeing to give me the money back, cool, I love it, but I'm guaranteeing myself to lose money because the money's not going to be worth the same when you give it to me. That's not cool. So, okay, so the interest rate on a 10-year bond is 1.75%, but the inflation rate is 7%, which means if you buy a 10-year bond, you're guaranteeing yourself a loss of 5.25% over 10 years. That's, as we like to say, cuckoo for Cocoa Puffs. All right, Ant, but that's a little unfair. It's 7% today. You don't know what's going to be tomorrow. You're right. I have no idea. Like, I think it's going to be high, but do I think it'll be 7%? I don't know. I really don't know. Because when you take a look at World War II, right? World War II happened for a lot of different reasons, but the rise of someone like Hitler is always due to economics, right? If everyone is happy, then the one person saying that it's, one people's fault is kind of like the cuckoo bird. Yeah, we get it. It's their fault. Go away. But if the whole economy is going to SHIT and everyone's doing poorly, except one type of people, or everyone's doing poorly and you could go ahead and blame one type of people, then when the economy is doing poor, everyone's susceptible to blame someone because everyone wants to find that person that they could blame and that could resolve it, right? Okay, so what allowed Hitler to get such a rise? What allowed Hitler to go ahead and be able to share a message that people were able to say, you know what, that guy's onto something? You got to remember, after World War I, when Germany lost, Germany was destroyed. They had reparations. They had to pay to the other countries that they got into war with. They had all of these different policies placed on them. They couldn't do this. They couldn't do that. Their debt levels went through the roof. They did not have any money. The point is, Germany was a very, very bad economy because they put all the money into the war. Then they lost the war. Then they had to pay for the war. It's like when you go to sue someone and lose it. Well, not only did you have to spend all the money for your lawyer, but now they're suing you and pay for their lawyer because why'd you do it to begin with? That was Germany. Really, really bad position. So Germany tried printing money. Okay, we have our own Dutch mark, right? Like a Deutschmark. Let's go ahead and print it and let's, this is how we can have money. The more, as you increase the money supply, the value of each dollar then coincidentally goes down because you have more supply, therefore less value per supply, right? So if you have 10 things and they're each worth $1, and then tomorrow you have 20 things, it's conceivable that now they're each worth 50 cents because it's all worth the same. You just have double the supply, right? Right. Okay. That's called inflation when you start eroding and lowering and eroding the value of the currency. But that wasn't actually what caused the inflation. Yeah, that causes a little inflation. Don't get me wrong. But what actually causes inflation that no one ever, and I swear, I think it's because I think CNBC and other places just like keeping you dumb. Because when you're the currency reserve of the globe, you can print as much money as you want. Everyone needs your money. When the entire globe is going through recession or something that has to do with contraction, they need more of the money. So the money goes into a black hole because the money goes to governments, and governments are the most inefficient uses of capital ever. They pay themselves. They're all dirtbags, right? So, and then banks are all super leveraged. So the money always finds places to go without ever going to the real economy. Because you got to remember, inflation is increased money supply versus goods and services. The part that no one ever tells you is it has to get to the goods and services for that money supply to become inflationary. So if the government decides to print $10 trillion tomorrow, and they give those 10 trillion to the banks. Now, how do you do that, right? The banks say, okay, government, we'll go ahead and buy your bonds. And then we'll just go ahead and leave the money here. But, we don't have the money to buy your bonds. And the government's like, don't worry, we'll do this thing called quantitative easing. We'll just go ahead and issue the bonds and we'll charge you a 0% rate to borrow, right? That's what the Fed funds rate is, 0. So banks can borrow new money at 0%. And they then take that money and then use it to buy government bonds. Government bonds are 1%, 1.75%. So banks get to make free money because banks and the government, and this is what we've been saying since day one, when big business and big government are in cahoots and they're a partnership, this is what they're doing. They're literally printing the money and then keeping it only within themselves. So the people never see the inflation because the people never actually get the money. It's just the banks and government churning and making trillions of dollars off it. Fine. Then COVID happens, and then you have enhanced unemployment. You have all these different programs that infuse money into the people's hands, into their pockets. Your payment protection program, your economic blah, 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 disaster loans, your enhanced unemployment, all that was money that they never wanted to give you, but they had to go ahead and keep you alive, right? So once that money enters your hands, it enters the real economy. Now you've increased the money supply versus goods and services. That's where the inflation starts happening. But governments can guard against that. Okay, so where are we going with this? When you're a government like the United States of America that owes $30 trillion, You cannot have inflation. You just can't. You cannot allow that inflation to go high enough that people say you have to raise rates. Because if you have to raise rates, then you are raising the rates on the bonds that are the interest rate that you have to pay back, right? So as the government, I say, all right, here's my number one job. I cannot allow inflation to the real economy because if the inflation goes up, I have to raise rates on myself. And if I'm paying back $30 trillion every single year at a 1% rate or a 1.5%, and now all of a sudden I'm raising rates on myself, now I'm paying 30 trillion back at 2%, 2.5%, 3%. Those numbers get pretty big. The tax receipts of this country is 3.5 trillion a year. At 12%, the debt that we have at a 12% yield, like an interest rate, means that the government, this country, would pay out every dollar that the citizens pay into it. The tax receipts for this country would be zero at 12%. Now we're only at 1.75%, but if inflation's 7% and any yield under 7% is guaranteeing you to lose money, what's the government got to do? They got to go ahead and lower that inflation rate by going, and the only way they could do is by raising rates. But they can't do that. So how do you actually go ahead and lower that rate? Well, you say you're going to raise rates. Because then when you scare everyone that you're going to raise rates, you bring down the wealth of the nation because the stock market starts crashing. Because the stock market's been inflated on free money for God knows how long. So as long as the stock market believes the money's always going to be free and it's always going to be injected into the economy, the stock market will continue to go up because companies are very, very good. They know, all right, if there's the circus in town, if that big macro thing's there, we'll find a way to get that money. Therefore, as long as the money's flowing, the stock market will go up. Well, if the money stops flowing, the stock market goes down, right? And if the stock market goes down, what happens to the wealth? What happens to your bank account? What happens to all that stuff that inflation caused? It all goes down. Because if you have less money and you have less money and you have less money and you have less money, then we've decreased the money supply in the economy versus the outstanding goods and services. Therefore, the government right now is purposely crashing the stock market so that they can go ahead and fight inflation without having to go be honorable people and raise rates because they know they can never afford the rates that they would have to raise. But they're doing it at this point of the year because these dirtbags have midterms later. And they're going to then run the stock market into it and allow everyone and convince every moron out there, hey, look, everything's great. Joe Biden really is a good president. He's great. He's great. Look at your wealth. Look at your stocks. Look at this. Look at that. The point being, if we know that they cannot raise rates, and if we know that they're playing this shell game, and if we know they can't raise rates because they owe more money than they could ever hope to ever get back, and that they are actually at the table questioning, like, what do we do so that we don't have to, so that these rates don't go up because they'll bankrupt us? Do you want to lend money to that person? Seriously, when you have $1 trillion, you say, oh, I think I'm going to give it to the government. No, that's like out of control. You would never, ever give it to them. But because you know what we just said, you'd be taking it and putting it into companies. You'd be putting it into stocks. You would say, not only does the government have absolutely zero ability to control their finances, not only is the government 30 trillion in debt that they can never afford to give back. In fact, the GDP of this country, I think, is like 24, 25 trillion, which means we actually owe more than the country's worth completely liquidated. I would not lend money to that person. But here's the catch. Oh, well, it's guaranteed. The money, they're going to pay you back. You know why? Because the US somehow invented this thing called a printing press. And if they don't have the money, they print it and then they give you that money, which increases the money supply versus goods and services. So the US is able to guarantee you that the money they give you by one of however many different ways is not going to be worth what it's going to be worth in the future. To get back to the history lesson of Germany and Hitler, if you remember a thing called Weimar Republic, and that was a German republic, but the inflation rate was so high that people would actually steal each other's wheelbarrows and leave the money behind because the money was never going to be worth the same it was going to be worth tomorrow. But the wheelbarrow, that was going to be worth something because a wheelbarrow had a functional use. It was an actual asset. How did that happen? Well, the government that owed more debt than they could ever dream of paying back said to the people, and said to the institutions, said to the banks, said to the pension funds and the retirement funds, hey guys, we're all in this together, right? Right, this is our country, like this is us. We're going to go ahead and replace 10% of everyone's money with government bonds. Like, guys, you need to help out. We're the government, we're in so much debt. Don't worry, it's guaranteed, but we're taking 10% out of your account and we're giving you that money in bonds. And it's, guys, it's guaranteed, it's got a yield, you're gonna do great. When the government did that, you know what happened to that Deutschmark? Everyone lost trust in it, because you can no longer own a currency that if the government feels like doing it, they're just going to take it from you and replace it with their funny money, replace it with their IOUs. Therefore, the value of the Deutschmark got annihilated. The inflation rate went through the roof. And those that were out front and center, because the Jewish population always was very good with money. And I think that's a cultural thing, right? Like, I don't know where the line is, what I'm allowed to say and not, but I think it's fair to say that the Jewish culture is good with money, right? Okay. In Germany, they were the ones that predominantly owned the banks, owned the media outlets, owned different things that would exude that they were successful. They were from a culture, they're a successful business-minded culture, amongst many other beautiful things, right? But in that situation where you have the government going ahead and taking advantage of the people, and then you have a particular demographic that is successful, one can then make the statement, oh, look, they're so high up, they obviously had influence into the government. Look what the government did, therefore they're the ones to blame. And if you don't believe me, they're the ones with all the money while you guys have nothing. Because the problem is when you take everything away from people, whatever the reason is, people lose it. When people lose everything, they lose it, right? So you had the inflation rate go through the roof. Now, I don't know what kind of parallels you can draw to today, but because the way pension funds and retirement funds and mutual funds are run, they have to own, I believe, 70% in government bonds. They just have to. Now, when government bonds are yielding 1%, 1.5%, every pension fund in this nation is insolvent because they can't pay the guaranteed 7% that they once promised. And if those interest rates start going up, not only can they not pay that rate, but the overall value of their portfolio, because the bonds lose value when interest rates go up. Why is that? Well, if I'm a bond that's yielding 1% today and a new bond comes out tomorrow yielding 1.5%, well, that bond's worth more money because it gives you more money back, right? So this one will go down in value. Meaning, there is going to come a time in this nation where the government is going to have to bail out the entire retirement sector of this economy. And I don't know if you've noticed, but baby boomers are getting up there and they're all drawing from that retirement now. In fact, baby boomers have 70% the wealth of this nation. Therefore, it is conceivable to say they're ground zero. They're the ones that are going to get hit. And they're going to pay for everything this government wants to do and everything that this government says build back better, right? The point of all this is whether you agree with me or not, or you say, Anthony, I kind of agree with you, but you're going off the rails somewhere. That's not the point. That's fine. The fact that we can have this conversation when you bring it back to that macro decision where you're going to put your money, you say, I'm not putting that much money in that government. Are you out of your freaking mind? They're out of control. I would never, ever, ever, ever. And if that's the case, then you're always going to put a larger percentage of money in the private sector, because the private sector has balance sheets that are able to withstand anything the government does. For instance, Apple, I think, has like over $200 billion sitting in just cash. Apple was worth $3 trillion as a company. And I'm not just saying Apple because we own Apple, because that matters nothing. We own options in Apple that expire in 4 days. That is not owning Apple, the company. That is gambling on Apple, what the price is going to be this week. So those are two different things. But where they do coincide is that it is my belief that when money says, okay, the market came down enough, let's get back into it, they're going to start rushing into companies like Apple that are effectively their own economies. Apple is its own economy. If Apple said to the country, hey guys, you could go kick rocks, we're going to go own that island over there, and we're going to call it Apple, they would immediately be a $3 trillion economy. Now, $3 trillion is more than 70% of the countries in this world, right? So it's not that you're buying Apple, the company, but you're actually kind of buying Apple, the country, right? You're buying Microsoft, the country. You're now saying, all right, well, there is public sector and there's private sector, right? I get that there's government and there's stocks, but there are stocks that have so much cash and have so many customers, and have such a following that if they decided to buy an island, they actually would be a country. Because does anyone believe if Apple offers a bond at 2% or 3%, that Apple's not going to pay that 3%? That would be crazy. Apple has the money to pay as much as they want. In fact, Apple, I can't say that they're going to do this, right? It's my personal opinion that at that earnings announcement, they're going to announce that they're going to raise a dividend and or do a stock repurchase because they have so much money and the stocks come down so much. And if that was the case, the stock's going to be through the roof by Friday, but am I going to stick in there? Probably not, because I'm not going to gamble on Apple earnings, but maybe I will a little bit. I have no idea. I would like to get out of my Apple stock today or tomorrow. That's me. I don't know where it is. We're going to do a screen share and find out where it is. Who knows? Maybe I'm down $1 bazillion right now. It doesn't really matter. This is an educational platform, and if it costs me a couple of bucks to teach people some stuff, I'm okay with it. The point is, that's the economy we're at right now. So where this all comes together is right here. When you're looking at a stock market going down, to understand the difference between liquidation and crash, and sometimes they're the same thing, but to understand the difference of if it's going to be a crash, you have to know the reasons it's happening. And to go ahead and not only understand the reasons, but you have to understand the exit. How does it all end? And if we understand this economy well, if we understand the global macroeconomics well, we know that the stock market is purposely being brought down now to lower the wealth effect, to lower the inflation so that the rates never have to go up. If that's the case, then the big money is sitting on the sidelines waiting to get into the market because they're looking to buy stocks over that of offering any money to countries. Okay, if that all plays out and you have the midterm elections later this year, that all sets up for the most explosive moment where the stock market can run the rest of the year. The point is, when does that start? And if we know that here, then other people know that better than us because I'm not the smartest person in the world. Therefore, this is going to potentially set up to be a whoop, and you have to be in it. Because when that happens, the majority of the profits, those explosive days, up and down, up and down, up and down, all happen when it looks the grimmest, right? So to bring it back to what we were saying yesterday and where I was going with how we were talking at 10 a.m. and how Jim Cramer's talking at 6 p.m. is what is the difference between liquidation and when does it come capitulation? The market was down 1,100 points yesterday. The market closed up 100 points. The market had 9 stocks down for every 1 stock that was up, and then ran the rest of the day 1,200 points. Now, what does that mean? Does that mean we found capitulation? It means we got close to it. It means that everyone that could have sold said, this, I'm out. And then those people that we just said are waiting were like, ha, okay, good. Let's buy that. Let's buy that. Now, by the book, what then needs to happen is the stock market either starts today down or cascades down lower and matches or gets close to the low yesterday. It's called testing the low. Now, I don't know where the market started today. I know that the futures were down, so I'm assuming the market started down. I'm assuming the market's been down as I'm talking. If that's the case, you had a down 1,100 point day yesterday that rebounded, which means a lot of people made a lot of money in that rebound. Now they come in today and the market's down another 300-400, and they're like, you know what? I should have learned my lesson yesterday. I'm out. Now say the market goes down 700-800 today, 900, and we get close to that low yesterday. That's called testing the bottom. If that then holds, right? We're down 1,100 yesterday. We're down 900, 800 today, or we're down 400 and we go higher. That's close enough that people say, look, the low held. This is a good place for me to dip my toe in. And why is that? Because professional money managers need points of references. Now, if a professional money manager says, okay, that's the case, I'll buy here. What is he doing? He's buying the stock at these levels, but he knows that low. If it gets lower than that low, he says, I don't care, sell. That means I bought too early. Which means if a professional money manager who has money on the sidelines has the opportunity to get in and has defined risk reward, that's all they can do. That's what they're paid to do. They're paid to understand the defined risk to reward. So they can conceivably buy today and know that their risk is that level. If it gets to that level, they sell the whole thing. If it never gets to that level, they ride it higher and keep buying as it goes up. That's where we are right now. So what is our catalyst event to get to there? Well, you have to have some confidence, right? All right, so what's that look like? Okay, so the Fed Reserve meets today and they give their announcement tomorrow. If we're correct, we believe that they're, see, I can't handicap this because they could come out and perpetuate this and speak really hawkish tomorrow. Like, hey, you know what, we're definitely raising rates, we have to raise rates, we have to raise, but we're just not doing it yet. Because the next meeting's in March, which means if they did that, they could tank the stock market and then they could say little things from here to March. Oh, you know, things really went down. Things changed the way that, you know, what we once believed no longer exists because they're lying dirtbags. That's all they are. They don't even get me started on the Federal Reserve. They are the biggest group of SCUM bags ever in the entire history of the world. So anyway, so they go ahead and say, okay, you know, things change and the wealth effect and blah, blah, blah. There's no inflation. We don't need to raise rates. That would be happening during February, which would mean that would set the groundwork for that move higher. Or they come out tomorrow and say, yeah, blah, blah, blah. We're looking at things more carefully, right? Like we're looking at things like we haven't seen it before. And now that's this cue to the market. Hey guys, good. Now let's go high. I don't know, maybe one way, maybe the other. Or you have Microsoft reporting today after the bell. Microsoft has a lot of money. They just went ahead and put $70 billion to go buy Activision, which means they're probably not going to buy back their own stock, but they just put $70 billion to buy another company, which means they're saying exactly what we're saying. Hey guys, I'm not a company that has $100 billion sitting around. You know what they usually do? They buy government bonds because the money, they don't need it. They just put it in a safe place that's guaranteed that they get a return on. Microsoft didn't do that. They said, I would never in a million years give money to that government. In fact, I pay people to not give them money. I pay accountants so I can have my tax rates down. What I will do is I'll go ahead and buy that company though, because that company is something I believe in. That's something where my money's not going to inflate. It's a productive asset and it's undervalued compared to what it's going to be worth because it's government. I know what they're doing. Okay. So Microsoft may not come out today and say that they're going to do a buyback or they're going to raise a dividend. I have no idea. But if they do, they should. Okay, so what's tomorrow? Tesla. So tomorrow you have the Fed coming out, right, and talking, and you have Tesla after the bell. Now, Tesla's interesting because it's a company that's valued at like 300 times their earnings. It's a company that is not profitable unless they have government tax credits, right? All of that being said, Tesla is a very speculative issue. Tesla is one that if you valued it according to college, it'd be like a $10 stock. But if you value it according to what it's going to do in the future and animal spirits of investors and behavior in loving Elon Musk and the prospects of what it can do, it can go to Mars, all this other nonsense, well, not nonsense, all good stuff, then you would say it's worth a lot of money. The point being, the price action of Tesla is going to completely reveal what the spirit of the mindset of investors is. Because if Tesla goes up on earnings, investors are saying, okay, we'll pick our points. We know what's going to happen. We'll take this. That's very revealing. If that were to happen, the market's going to be up Thursday. Now you have Thursday where Apple reports. Now, Apple's always done well. Apple's the single greatest company in the entire group, right? I don't think anyone dismisses that. Maybe some people would argue, well, actually, it's Amazon or maybe it's this company. It's up there, right? Let's say top three. Anyway, meaning that if Apple's still down Thursday, with them coming out and reporting numbers Thursday night for their Christmas quarter, people are going to say, all right, the market came down enough. Let's get into Apple before they report that number because the number is going to be great. The stock came down. Let's get into it today, which means there should be a natural run up to it. Now, we believe that to be the case. That's why we own it. We believe the catalyst event of Thursday evening, Thursday after the bell, is going to allow it to have a limited downside and have a potential run up. That's always been our thesis. Now, unfortunately, I believe it's probably down, right? We're going to look at the stock market, but I believe it's down. So that doesn't feel good because if someone came to me and said, Anthony, sell your account right now, I'd have to look like a Momo and be like, all right, well, I'm down money. But the game's not over. And I still have more money. We didn't buy all of it. We could buy more right now if we want to. That's what we're doing. That being said, we believe that after the bell Thursday, Apple, who has no new product, right? They are still talking about the Apple Car, and maybe they talk about that a little bit more. the EV Apple car, which would be so cool. Like, come on, they would kill Tesla. But with 200 billion on their balance sheet, and it was 126 billion before Christmas, and we're just assuming it's 150, 160, we're rounding it to 200. So let's say it's really 175 billion on their balance sheet. I believe they have 16 billion shares outstanding, which means they could go ahead and offer $1 dividend for 16 billion a year, right? That's all it would cost them. Do you know what would happen to Apple if they raised their dividend by $1? The stock would probably double. Like, it would be a big deal. Or Apple could say, all right, we have all this money, we have 16 billion shares outstanding. You know, we're going to do a $50 billion stock repurchase program, and that should allow us to buy back 1 billion or 2 shares, right? Okay. Actually, no, it wouldn't, because the stock's what? I don't even know where it is. What is it, like 160? Don't tell me where it is because I want to look, but I think it's like 160-ish, right? Whatever. The point being, they could buy back maybe 500 million shares. Well, if you know that the company is not only buying their own shares, but they're competing with you on price to buy the shares, you're going to go buy the stock because duh, if there's all these people buying it, why wouldn't you? And the idea is going back to the beginning question, where would you put your money? Apple does have 200 billion. Where are they going to put it? They have no new product. How much money are you really going to put into building a car? You don't fund that program 200 billion. You say, okay, we'll put 10 billion on the side. You guys could do with 10 billion, right? It's like kind of like a lot of money. All right, we need to make a new iPhone. All right, let's put 10 billion over there. All right, we have 140 billion sitting here. What are we going to do with it? We can't increase people's salary. All right, let's donate some of it, right? Like, let's go send some to Cambodia. Let's send some to India. Let's send some to like wherever. Okay, 5 billion, right? Right? We have all this money. What Apple then understands is what the market knows, that the market is chumming with sharks that smell blood. Because if Apple has that much money and they don't do something with it, then you have hedge funds and activist shareholders that say, hey, you have all this money and you're not giving it back to us. You are not helping shareholder value, right? Because that's what the company is. That's what the board of directors is. They're stewards of shareholder value. It is their job to put the best practices in place that allow the stock to go up in value. And if you have all this money where you could buy back stock responsibly or give a dividend responsibly, that allows the stock to go up in value because now you're more valuable to stock. If you don't do that and you allow your stock not to go up on pure greed, or that you want to hold the money for whatever stupid reason that you're not telling people, then people start attacking your company and saying, look, look, look. And then the ultimate outcome is, well, you got to do it anyway. I think Carl Icahn did that to Apple years ago. The point being, Apple's not stupid. They know that. Therefore, if they have that much money and they don't have a purpose for it, it stands fair to reason that they're going to announce that they will do something with it. Upon that announcement, if you go ahead and coincide that with where the market is, where the market wants to be, where it's going to go, where the money flow is, and what companies are doing with their money, you can then build an argument that this is the time that you'd want to own a company like Apple. So that's our belief, right? Now, what we're doing is we're owning it in options that expire this week. It's the most speculative thing out there, and we could end up by Friday, if that stock is not over 165, our investment goes to zero, right? So we are not, I need to make that distinction. People that own stock are equity holders. They own a piece of the company. People that own options are simply gambling on the price of the stock. So all this argument we made about Apple, the reason that we're cognizant of this argument is because it is our belief that the market understands this argument and is going to start representing it and demonstrating it, that we believe all this is going to come together and the stock will go up for the rest of the week. But we've been wrong plenty of times. If I have to take a 50% loss, I will, because it won't be the first 50% loss I've ever taken, and it won't be the last 50% loss I've ever taken. The idea is, can I make more than I lose? That's the name of the game. Woof. That was fun. Okay, cool. So it's now 10:39. Let's go see the market. And this is always the fun, right? Because I might pull up this market, it's down 1,000 points, and my Apple's like getting crushed. Or I can pull up this market and the market's up and I can look kind of smart. I don't know. But my belief in Rhino is that there is no smoke and mirrors. There is no curtain. Here we are. You're going to see my face front and center, and let's figure it out together, because I do not have the luxury of a 6 o'clock show where I can say, yeah, duh, at 10 o'clock, anyone that did that was cuckoo, when in reality, I was only able to say that because I could look at a chart and see what happened at 10 o'clock. No, this is for real men, real people that are in it real time. We win, we lose, but we do it with pride. Not pride, with nobility, because pride goeth before the fall. All right, let's see if I just gave a really good speech from someone that's losing money. I probably am, so let's see. Okay, so let's see where everything, oh my God. The market's down 400, jeez Louise. Okay, so let's see. All right, so the market's down, wow, Nasdaq's down 320. I can't wait to buy more. I'm buying more today, I don't care. Thanks so much. Okay, so let's take a look at the charts, right? So this is Apple. Now, this is interesting. Well, first, let's go to the QQQs, right? Let's take a look at the overall market. All right. So this is the QQQs. The QQQs are the NASDAQ 100, and it's the ETF. Now, what you will find is, so we're going to pull this down. And usually I won't look over to the right. And those that have been with me for a long time, no, we always look at the left first. So we're not biasing the right, because this line is what we call a trend line. And we don't want to know where this is while we're making it, because now it becomes a self-fulfilling prophecy. We're making it to fit a narrative rather than we're making it to affirm our opinion rather than inform our opinion. Those are different. But in this case, this line is so precipitous that we want to know if it correlates anything on the left side. So we built it so we could touch this first, right? Right. And when we look over the left side, we can see that it is a trend line. When it broke above this, it stayed above it. It bounced off it as support, went back higher, had a double top. When it broke it, it came down, tried to get over. It did pop its head over, but unfortunately failed, came all the way down. Came up, bumped its head on it, came down. Bumped its head on it, came down. Once it broke it, never looks back, right? So what yesterday's low of the day in the NASDAQ told us was anyone that owns stock between June of 2021, and right, I'm looking right here, June of 2021 to yesterday effectively lost all of their gains. So that's a lot of people. Look at all this volume. All of these people have made no money. And all of these people conceivably sold over here. All right, I want to have some type of profit. I want to have something. Oh my God, my life sucks. Okay, cool. Okay, now what is this green line? And for those that know us well, they know exactly what this green line is. This is called a trend change bar. We coded it. That's why we know what it's called, right? And what this bar tells us is that the volume was so strong that this volume was 3 times the trailing 28-day average volume, which means over 28 days, whatever the average volume is, this was 3 times that in one day. That's what we call capitulation. Now, usually we like to see 2 green bars back to back, right? That allows us to confirm it, right? But what you can see here is this volume's been going up, right? Like this volume is a whole lot. And again, we still want to see 2 to really feel it. But when you have a drop this precipitous, this is when everyone's just kind of thrown in the towel. Okay. So now this market is where we are today. We started here. You can see that line, right? Now, I don't know if we started up or down, but we did go higher. We did go lower, and now we're off the lows. What you can see let me pull this up a little bit more. What you can see very clearly is that people are fighting. So let's go do, what time is it? 10:44. Let's do a half-hour bar. Okay. So this is where the market opened. Okay. This is where the market opened. Oh, it opened on the lows, and it's been fighting up ever since. So like we started by saying, you want to see a market start low and then people fight. Okay, I'll pick my points. I'll pick here. This is the line that needs to be protected. If it gets under this, it's a real problem. Like you just need to sell everything because we don't know how low it's going to go from there. But what we can see is that this is very constructive. So if we pull a 4-hour chart up, we can see, all right, remember we want to see all those trend change bars? We want to see 2 in a row. There's your 2 in a row. Now this is on a 4-hour basis, which means between the two 4-hour periods yesterday were so high volume that look, trend change bar popped up. Now it's fighting within, but it's not at the low. the lows, it's not at the high, which means it's contracting, it's constricting. Everyone's getting in there and something's going to happen. It is our belief that this is going to go higher. It is our belief that this market's going to move up the rest of the week. But I don't know that to be the case, right? Like, what do I know? So let's take a look at the volatility. Now, this is the volatility on a 4-hour span. Again, this whole chart's on a 4-hour span. So let's do our arrows, right? So market is lower here, right? And then market is higher here, right? Okay. So what happened with the volume during that time period? The volume is up over here, and the volume is down over here. But this is a little misleading because the market's open from 9:30 to 4, which means that equals 6.5 hours. That means these two bars, this first one's 4 hours, right? But this second one is not 4 hours. The second one is 13:30 is 1:30, 4 minus 1:30 is 2.5. This is only 2.5 hours, which means this bar would have been much higher if this was a 4-hour bar. So let's see if that's true. Let's do a 2-hour bar. Okay, so what do we see? Stop. Price is down, and this is over 2 hours. But this is interesting. Could we have seen this, right? Look at the price going down, and look at the volume going down. This is the first time we've seen that. It's starting to become wildly exhausted. All right, now the market's going up. Okay, the volume spiked, right, at this moment. That's called capitulation. That's when it spiked. And look, and the volume started going up here when the market's going up. Now the volume's down over here, but what is this? This is where we're starting today. The market started lower today. The volume's down on a lower day. So this is where we closed yesterday. This is where we are today. Now what's going on, right? So while it was going up and while the volume was going down, volatility was also going down. That's very good. Now, mind you, this is only on a 2-hour, so you can't get too much into it. But what is the biggest component of the QQQ? It's Apple. So let's see what Apple's doing. Apple got down to 157 today, which is really ugly. But I wish I was there to buy more, right? What do you know? Okay. So this is Apple. Let's do it over a 4-hour span, and let's see what's going on here. Okay. By the way, on a 4-hour span, it's a 15 red and green. And anyone that's been a part of Rhino for any period of time knows 15 red and green is like, you start salivating. I always buy 16 red and greens, which means if I didn't own Apple, within 4 hours, I'd be buying Apple. So I own it. All right, so stock is going down. Volume is going up, right? And volatility is going up. Okay, that's not good. But what happens? We get this point, the volume spikes, and we bounce off it. So now price is going up, but the volume's going down, which is not good. Because how long can that actually last, right? So let's just put this over here. But again, you can't really make that call because this is a 4-hour bar, this is a 2.5-hour bar, and this is what, an hour bar? So you have to pull back and let's go to 30-minute bars, right? Because 30 minutes is fair. Because we don't have days, right? Like this has only been a 2-day event. We can't measure 2 days against each other with today being the second day. But with half-hour bars, we can because there's been plenty of half hours. Okay, so stock's going down, volume's going down. Come on. Stock's going up. Volume staying sideways. Stock's going up. volume's going up. That's good. Stock's going sideways. Well, actually, I guess that's down, right? What's volume doing? Volume's going down. In fact, what's volatility doing? Actually, you know what we're going to do? I have volatility for Apple. Okay. Volatility is going down. So you have price going down, kind of staying sideways, volume going down, and volatility going down. That tells you that the next move is likely going to be higher. Look at Tesla. Tesla went positive. So what were we talking about, right? So let's take a look at stuff because maybe Anthony wants to buy some stuff. I don't know. Is Anthony feeling sexy right now? I don't know. You know what we're going to do? We're going to buy nothing. Now, that being said, if I did not buy anything, I'd be buying tonight. But because I already bought a lot of stuff, I'm thinking about not buying. Because let's see the market shake out. Because this isn't good. Microsoft is reporting numbers today, and they're down 6 points. Right? Microsoft should not be falling apart right before numbers. But maybe the numbers aren't good. Or maybe they're just getting all the weak hands out. I don't know. Let's see. Do we have any numbers? Ooh, Etsy, 20 red and green. Now, I got to tell you, I mean, I think I'm supposed to buy that. So let's do that. Let's go buy some Etsy. And we'll do it for a month out. All right. Yuck. All right. Let's go buy some Etsy. How much do I have? 4,600. Okay. So let's buy the options in Etsy. Let's put this out till next month because we're not playing earnings. Actually, earnings on Etsy, I think, are February 2nd. So that's kind of cool. Man, Etsy's expensive. Okay. So we have 4,600. Oh my God. So it's 147. Let's buy, well, not let's. I will buy. Look at 180s, 2,600 contracts traded today. That's insane. So you know what? Let's do 160s. Let's do 162. No, let's. My God, that's so much. Let's just do 160s. So we'll buy some Etsy. Why not? Buy to open. Let's limit this. Now, how do we do the limit? 675 plus 740 is 1340. 14, 15, 15 divided by 2 is 7.5. 758. 658, right? Okay. No, I did that math completely wrong. So 25 and 40 is 65 divided by 2 is 32.5. So it's about 705. Okay, so let's do 705. And let's buy 9. I could afford that, right? Cool. Oh, because I can't count. Duh. Let's just do 5. No, let's do 6. Right? Okay, cool. Place order. And they gave it to me, which actually isn't a good sign. You don't want them to just give you the stock all the time because you're like, how many people are trying to get out of this thing? But we're holding it for a month. So we're in at 705. Okay. So we just purchased February. What was that? 160s, 160 strike calls on Etsy at $7.05. 6, right? Okay. So that's that. All right. And that's all we got for today. Let's see where the market shakes out. We are of the belief that today is a very, very important day because today is going to let you know. And here's the thing, right? So the market doesn't have to end up today. It just cannot fall apart. That's all we don't want. So the market's what? Down. Where is the market, right? Let me pull it back up. Wow. Okay, so the market's down 326 now. It was down what? 500 before? We just don't want it to fall apart. Let it just kind of do its thing, because if it doesn't fall apart and just stays negative, then the volatility comes out of the market. It's not moving so fast. Then big money could say, all right, I can step into this because it's not so volatile anymore. It's not flying all over the place. I can step in here and take my shots. And because it stopped going down so precipitously, one can then make the argument, all right, whether this is long-term or short-term, I can convincingly and believe that it stopped going down, which means there's going to be a shot to go ahead and make some money on the upside. Because we're in America, people like the score, people like touchdowns, people like home runs, they like the number going up. The people that like the numbers going down are really, really like people that you wouldn't be friends with, and they're about to be done, right? So they've done all their selling, and it could go lower, who knows? But I believe that as long as the market doesn't fall apart today, that the rest of the week will look good. And that we will look back at this and say, that was our shot. Again, when it looks ugly, remember the saying, when there's blood on the streets, you buy real estate. When everyone is telling you that the stock market is garbage, it's going to crash, it's going to get worse, Ukraine, Russia, blah, 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 that's valued in the stocks. The stocks are already exhibiting many people that don't want to own it. That's the price that they're. Remember, like anything else, okay, can I get a 10? No one wants to buy a 10. Can I get 9? No one wants to buy a 9. Can I get 8? That's what's happening with stocks right now. But is it specific to the stocks, or is it specific on sentiment? Let's go back to the beginning of this call so you can understand the macro underneath it all. So there's our belief it's going to go up. And again, we're going to caution you. We're playing it in a very speculative way. We're sitting here saying Tom Brady's so good that we bet he wins by 30. Well, Tom Brady could win by 20, and we're still going to lose our bet because we think this because of this, right? So if you're looking at what I'm doing and looking at my performance, that's what makes this a great research platform. I'm doing what I'm doing for me. If I was managing real money, I would never tell my client to buy a 1-week option. I can do that for myself because I win and lose by myself. If somebody were to say, all right, well, if Anthony believes he's going to win by the end of the week, I could go ahead and buy this. And even if he doesn't win by the end of the week and it takes him 2 weeks to win, I could buy this a month out and I'm well in the clear, right? So if you were to purchase an option or a stock that's a month out or 2 months out, you can still win while I lose. But if I win, you automatically are going to win. So it's all about your own finances, your duration, your risk tolerance. I'm just trying to offer you an education and showing you in real time what my thought process is and what I'm doing accordingly. This might be the best entertainment. You might just watch me lose or make money. That's fine. Get some popcorn. But if you want to actually learn what to do, that doesn't mean to go ahead and act. It means just pay attention. Because when you see what happens, there will be a day where you look back and say, whoa, 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 I've seen this before. And those that have been with us in Rhino for quite some time, how many different times have we gone through this where everyone's throwing everything out the window and we say, no, that is purely emotional. It's not logical. So can you paste here and check? I thought I did. Hold on. I'm sorry. If I didn't. I'm going to take Zoom and go to their headquarters and beat them all up. Because every time I post something, no, you Momo. All right, let me just do it. 6 February. It gets posted to panelists because I never look to change it. Calls on Etsy at okay. That's what I purchased. You might actually get a better deal now, but Etsy is 20 red and green. Woo! And those that have been with Rhino know that those are pretty good. I think more, have we ever lost on a 20 red and green? I don't think we ever have. I remember Twitter took us some time. I remember UNP took us some time. It went to like 23, 24. But it always got higher than where it was at 20. So whatever. All right, it's 11 o'clock. I gotta go. I have a call with my PM. And then I have some work to do. And then I have a doctor's appointment for my son, because I like being a part of our family. And he's perfectly fine. So if you're gonna ask, he's great. Don, how do euro dollars, US dollars, and banks overseas play into the bond notes interest rate scenario? So Don, that's actually a much bigger thing that I won't be able to spend time on now. I believe Zero Hedge posted a really great article about it. What I will tell you is when you get into that stuff, you're getting into the super duper duper black hole finance stuff. And what I mean by that is for those things to play out, the whole global economy would crash. So those are the things that the bankers say, okay, this and this and this, but that, no matter what, we'll fraud, we'll do whatever we have to do to keep that standing. And that's kind of what that is. So I wouldn't think too much into it, but we do believe dollar up, euro down, if that helps at all. Etsy is now 145.05. What did I buy it at? Did it go down since I bought it? Yeah, it did. Great. Wait, I don't know. Well, whatever. Oh, so the market went down a little bit more since I bought. So this is a good thing for all y'all. Go, if you were going to do it and you hadn't done it yet, you have a good price to do it at now, is the point. All right, I really got to go. Love everyone. See you tomorrow. Bye.